Portfolio managers are always seeking new investment themes and ideas to maximize returns for clients. And our next guest is seeing quite a few areas of opportunity for the second half of this year, which we just entered. What goes forward from here in this year and beyond? And how might liquid alts ultimately fit in your client's portfolio? Happy to say joining me here today in studio for a look at the long and short strategies you may want to consider for the months ahead is Fidelity Portfolio Manager David Way. Great to see you, David. How are you?
Nice to see you. Thanks for having me.
Yeah, delighted to have you here. You've been doing this, you've been managing this particular fund for 3 years plus some time before that. We've had absolutely everything in the market in those years. Why are we hearing more and more that, in fact, alts are the way to smooth out volatility going forward in a new way?
Yeah, it's a good question, and I think certainly my contribution to this is really providing clients with a wider opportunity set. So on the long side, it's doing all the things that Fidelity's known for, of seeking great opportunities, generating returns, and something we've been doing for a long time in terms of identifying underperforming companies through sell ratings and having negative views on the companies. Really bringing that into a client solution. And so the way that I think about my contribution to this is allowing clients to access the positive, optimist, growth-oriented parts of the market to help grow capital over time, but also really harness both what we're good at internally and my own personal skills in identifying companies to short that not only enhance returns, but also reduce the volatility of the portfolio and client portfolios as a result.
So the markets right now, I'd like to sort of have you take the pulse of the markets right now. We've got political volatility. We all know that. We read the headlines. Beyond that, there's always volatility, and arguably there's an interesting setup after having such concentration in the market. Does that provide more volatility going forward, less volatility? Take us into sort of the markets and the volatility story right now, as you see it.
There's a really big underlying assumption about how we define the market, right?
Yeah,
so
absolutely.
We tend to think about the S&P 500, which historically has been a diversified index covering a wide range of industries and largely diversified, though it has had periods of high levels of concentration. And while it may feel unique to have sort of the Mag 7 or whatever you want to define as the most concentrated part of the market, it may feel like a very unique time in history to have this level of concentration. We've seen it before.
What?
Well, if you look at the Nifty 50 era, 2000, you can get in periods where there's a lot of enthusiasm about a particular part of the market that drives positive returns for some amount of time, but you do reach a point where what actually happens is it opens up an opportunity for the rest of the market, the other 493 stocks in the S&P 500 and beyond, to really start to be better appreciated as we move forward.
So that's really interesting, because that's exactly the story of the first half of this year, as we all know. But we did actually see the broadening out. It did happen. There's sort of a question now that, okay, we saw pretty good broadening out. Now what? So how do you provide value to clients with the now what bit?
So in relative terms, the most concentrated part of the market, the Mag 7, has delivered significantly superior performance versus the rest of the market. And as a fund manager, it's my job to capitalize on those opportunities as well. Like I'm not typically a natural owner of the most popular, best research, most eyeballs on the stock kind of businesses. But when they're delivering superior growth, superior cash flows, superior risk reward, it's very likely that you're going to find those companies in my holdings. Where I start to get really excited is when there are large swaths of the market where I feel I have expertise that are being underappreciated. And you can look at it very simply. If you look at the earnings multiple of the S&P 500, it's pretty high.
Very high, yeah.
It's in the, call it 23, 24 times. And if you look at the S&P 500 on an equally weighted basis, so treating all the companies equally, it's much lower. It's closer to 16 times. And so while I'm not a valuation focused investor, it is clear that if you can find stocks trading at lower multiples with attractive growth prospects, that might be actually where you find a lot of reward as we look ahead.
So what are some of the themes that will drive you to those stocks? So there's one suggestion that the AI story has been overplayed and maybe some of those stocks are too expensive. Lots of people say they're absolutely not expensive. But then there's others that have almost been thrown out because they appear to not be able to handle this transition. I don't know. Is there something in between that's attractive to you?
Yeah, I mean, I think the AI theme has, I think fairly focused a lot of the price appreciation in the companies that are, doing really well. Like you look at NVIDIA, Amazon, Meta, Google. Yeah. These companies are really well positioned to take advantage of sort of the first wave of the AI benefit, whether it's selling chips if you're NVIDIA or integrating it into your ad algorithms and developing expertise in the language models that we're using to kind of initiate new businesses or new ideas around implementing AI. But in that second group, the ones that are being ignored or thrown out, there's really two buckets. For me, there's the companies that are AI losers. So their business is like absolutely in the crosshairs of likely AI innovation over the next 2 to 3 years. And so for the short portfolio, there's a number of companies where I've initiated short positions over the last year, really since ChatGPT really got released in late 22, where I expect these companies to face significant pressure. It's really existential risk for these businesses.
And has that worked out?
So the shorts have worked, and more importantly, you're starting to see the fundamentals of these companies deteriorate. So they're doing everything they can to put on a brave face, whether it's reclassifying revenues or trying to come up with short-term fixes around selling data to these AI training companies. But when you look and dig into the underlying user metrics and really the volume and profit drivers for these companies.
What do you mean user metrics? That sounds interesting. I feel like that's an interesting piece of the story.
Well, there's companies that do things like sell stock images, for example.
Right, okay,
And so in the very short run, what these companies can do is they can sell their libraries to the Metas, Amazons, Googles of the world to train their models. And that actually shows up as some revenue.
But just once.
Maybe just once. We don't know the answer to that, but maybe just once. And what you really want to look at is their user base. How are they responding to the newly available tools that they might have to find the very precise image that they're looking for? And so if you look at those metrics, you're seeing decreased engagement, decreased revenue generation. And those are the things that will drive the company's earnings over the next 2 years. So even though those shorts have worked, I think we're starting to see an acceleration in those negative trends, which strengthen a short thesis.
And so will that only, accelerate in that sense there is more and more clarity?
I think it's more and broader availability of tools. I think one of the things that AI can enable is the growth in the number of businesses in any given sector. So we kind of have somewhat fixed demand or a fixed demand trend for things like images. And I think what AI will do is it will massively increase the supply at very low marginal cost. And so I don't know if any of these new businesses are going to be successful, but what I can tell you is that companies that perhaps made money 5 years ago are going to struggle a lot in the next 5 years. And I think that those really long-term and significant trends remain underappreciated by the market. And what encourages me, as a short seller in this area, is that we're really starting to see, the top line drivers of the companies start to break down, and that is what will force people to, pay closer attention and ultimately pay less for these businesses.
And layer on the rates environment. So if you go back to the beginning of this year, again, we're sort of talking about the midway point of this year. At the beginning of this year, the markets are pricing in 6 cuts. And there were companies, and I don't know if they're the same ones that you're talking about, but there were lots of companies that were sort of holding on to, don't worry, cuts are around the corner. Just layer that into your thesis for investing.
I think there's a couple of industries where this is especially relevant. Like if you think about, the banking system, particularly in Canada.
Just quickly, your universe is US and Canada?
So I look at North America, I would say is 90% of my work, and I do up to 10% global as well.
Thanks.
So this comment would be about Canadian banks. And if you talk to the CEOs, like their main strategy for dealing with the mortgage renewal cycle that we're likely to see is that, hopefully rates go down.
Yeah.
The consumer in Canada is challenged by
the strategy is hopefully rates go down.
Hopefully they have other things going as well. But
Okay.
I think if I could give a headline comment from the number of bank conferences we've had in the last, really like 12 to 18 months, there's a recognition that rates need to be lower to avoid a meaningful disruption in the Canadian banking system. And so we're likely to see lower rates. And so to some degree. But I think it still creates challenges for the consumer who will have to renew mortgages at higher rates, and that will decrease disposable income. So when you think about Canadian consumer companies, that's potentially an area for finding good short ideas. And then there's a second bucket of companies. Being an analyst through the 2010s.
For which industries were you an analyst for?
All of them. I covered materials, financials, consumer, telecom, real estate, insurance. And I saw a lot of companies deal with a changing interest rate regime. So falling interest rates at the beginning of the last decade, great for real estate, really bad for insurance. It was great for low growth companies who could go out, make acquisitions at very low incremental debt costs and acquire other businesses.
Free money.
Free money. And so money's not free anymore. And there is a large group of companies that have balance sheets reflecting a free money world in a world where money costs things. And you're now actually starting to see companies start to sell trophy assets. So they need to repay a bond, so they have to sell their best asset, really damaging their long-term growth to repay a bond maturity. And when you start to see that, there's a bit of a vicious cycle for these companies. And it may take many years to play out.
So that's interesting. Why will it take many years to play out? Because there was sort of this idea of a cliff. What is the cushioning that means it won't all happen at once? Because here we are still at 4.5 rates, depending on which side of the border you're on.
So many of these companies have debt due at different times. And so to the extent companies have really termed out their debt, so they have long-term debt maturities, they may still be enjoying yesterday's low rates for some time. But as those bonds become due, if they're not generating enough cash flow to repay those bonds, then they have to do something else. And that something else is usually something that's damaging to the stock.
Can we come back to the consumer for a second? You're talking about, and we know the knock-on from sort of the mortgage story to the consumer. That said, there's been lots of discussion about the trade down cycle that's been going on for some time and actually just increasing. Take us through the long thesis for that.
Yeah, so I think when you look at Canada, there are a number of companies across a range of industries that I sort of think of as global champions. And perhaps they dominate an industry in Canada or globally where they have really strong unit economics and are very competitive and excellent capital allocators. And so within the consumer space, a company that's been in the portfolio, I think since inception, at different portfolio sizes, is Dollarama. And one of the really unique things about Dollarama is that it has an excellent box. It probably is the best store economics of any retailer on the planet. And most importantly, it doesn't have any competition. And so this is a business that sometimes will look optically expensive, but the long growth runway that they enjoy in Canada, the strong economics they have today, as well as the new vector of growth that they've been really developing over time in Latin and Central America, really provide the company with a number of opportunities to grow. And the fact that they're so good gives them the right to grow. And so the company's been very sort of careful about its international expansion, but the announcement to say enter Mexico, which is a great market for a number of US companies that have expanded, whether it's like AutoZone, Sherwin-Williams, or others, there's companies that have demonstrated success there. And again, they're doing it in a very staged fashion with a partner in order to manage the risk to the core business. But you compare that against the experience that some of the dollar store companies are having in the US, they're really struggling with growth. They're really struggling with margins. And
competition.
And competition. And Dollarama has managed to remain above the fray.
Isn't that interesting? Let's go to some of the other sectors. So we talked a bit about the consumer. We can come back there. It's a big story threaded throughout the economy, obviously. Financials, a little bit. Actually, within financials, if not the banks, then what? Because you mentioned insurance earlier, but
Yeah, I think the one of the things that actually comes up with clients quite regularly is that the fund has an optically large position in the financial sector. And when people think financials, they tend to think banks. And personally, banks tend to be pretty capital intensive businesses, largely subject to, I would say, strong competition. There are good businesses within banks, but at the same time, it's not usually a natural place for me to have a significant weighting. So when you see financials, for me, what that means are companies in financial services where they have really strong margin profiles, really good at allocating capital, lots of growth. Typically, they tend to be global businesses.
Are we talking about exchanges?
Could be exchanges, yeah. It could be exchanges, could be credit card network companies, could be insurance brokers. If we think about anybody can look at their insurance bill in the last few years and understand that there's been
why don't I invest in that
significant inflation. And if you're an insurance broker, you earn a commission on an insurance premium, and as those premiums rise, your commissions go up. And so they've been really strong organic growers, and I think perhaps this has been true for a few years, but potentially as we look forward, we could go on with continued inflation in insurance premiums, due to a few things, whether it's social inflation, so higher cost of lawsuits for companies, more frequent extreme weather. There's a lot of different moving pieces within that sector, but to the extent you can expose yourself to those companies that benefit, it's really can be a good source of attractive returns.
How has the short side of the portfolio done? Any surprises there, one way or the other?
Yeah, I would say the biggest surprise I've found is that despite a rising market, and I would say periods of relief where people are expecting rates to come down and sort of conditions to ease for companies, the short portfolio has done pretty well. It's contributed alpha to the fund. So even in a rising market, there has been value to shorting stocks, and it's hard.
I'm sure.
You have to pick the right companies and invest well and do your analysis. But there are opportunities to make money from shorting in a rising market. That being said, what I really look for the short portfolio to do is that in periods where we see downward volatility in the market, like the market going down, that it's an important part of ballast for the fund. And one of the key levers that I have to manage that is that in periods where I'm really optimistic about the market and see a lot of upside, I do have the opportunity to sort of shrink the short portfolio. And
so what is it, roughly 130?
So
30?
Over time, I hope to run the fund in the 130-30 or sort of close to fully exposed to the market. I've actually been running it at a lower rate, closer to 80% net exposure. And despite that, the fund has generated attractive returns relative to other long short funds as well as the indices. So I'm actually pretty proud of the returns of the fund despite the lower sort of exposure to the market. It means I've had to run harder in terms of finding winning stocks. But as we look ahead, I think I've said it before that I do keep a list of stocks that I'd like to short if I can find the fundamentals and the valuation line up. And what I would say is over the last couple of months, more of those stocks hit the point where I'm like, okay, this is a shortable situation. And the end product of that is a bigger short portfolio, which I think will provide more ballast to the extent we see volatility from whether it's conflict in the Middle East and Europe, the U.S. election cycle, or just general movements in interest rates.
So that brings in the discussion that we keep here. We sort of started this discussion this way, and there's lots of questions coming in, so we'll get to those in a sec. But this idea of where it fits, this idea of, is it the new 40 side of the 60-40? When you start talking about providing ballast and something that is not correlated ultimately to the rest of the market.
So I have 100% of my assets invested in this fund. That's probably not the right allocation for most clients, but I think it's important to align my interests with other fund investors.
So it's core for you?
It's core in everything. It's core and periphery. Okay. And but I think this fund really fits in nicely, I think, in the middle. I think it's important for clients to understand that this is, even though it has lower correlation to the equity markets, it is an equity exposed product. So I think when you think about the fund, you should think about it coming from the equity sleeve. But I think all clients...
On the 60.
Yeah,
in theory.
And from the 40, there's all kinds of other alternatives you can consider, whether it's market neutral or, credit-based strategies. I don't have a lot of expertise in those, so not ready to make any recommendations.
You'll leave that for your colleagues
I'll leave
to
that
pick
for
up.
other people
Yeah,
to
okay.
opine on, but I think it's important to understand that this fits in the equity versus the fixed income sleeve. And I think, who it fits for. I think every client can benefit from a strategy that has, demonstrated higher returns with lower volatility over time. I think it's really important for this fund, to deliver both, because I think that's what clients should expect from a strategy like this.
Fantastic. And if it was to fit on sort of the theoretical 60, would it augment, would it help, a more conservative, like you have a bias to growth, there's alpha, it's something that's moving. If there's within the portfolio something that's more along the lines of quite a conservative approach, this could slide in beside it.
Sure, I think the things that it could complement would be if you have to the extent you have, a portfolio of dividend-paying securities.
Okay.
Perhaps you have exposure to, growth. While the fund is style agnostic, I will have some growth, some value, just really where I see the opportunities. Sort of a pure growth strategy would complement that. Will lead to more volatility, but I think this is a fund that can provide really good ballast to a growth portfolio, as well as I think even within Fidelity we have really strong small cap capabilities, so I think it could complement a global small cap strategy as well. But I think this fits in really within the core of an equity allocation.
Fantastic. Thank you for kind of sketching some of that out for us. Some great questions here. So let's go to them. David, what are the risks of the long-short strategies in the current market recovery?
Yeah. I think the biggest risk is that the market really keeps going and is driven by momentum growth stocks that perhaps don't have the valuation support that I need to make those meaningful positions. The fund has demonstrated an ability to find winners in any market. So, I'm still working hard to try to find valuation support with the level of appreciation that generates returns for the funds. But I always think of like opportunity cost as potentially a risk. I think the second risk to the fund really is to the extent we see really meaningful valuation or style biases,
right.
Win or lose, and therefore maybe other opportunities will have looked better with hindsight. But I really try to manage risk out of the fund. Like it is central to my process, and so to the extent we have high volatility or low volatility, I think the fund is well positioned. If there's a market downturn, I think it's really important for the fund to be positioned to capture as little of that downside as possible. Like my whole philosophy around winning is that you participate when the market's up, you protect capital when the market's down, and that way, during those periods of volatility, you hang on to capital, you keep clients invested and trusting you, so that when that next leg of upside comes, your clients are there to benefit from it as well.
Okay, another question. David, how do you cost the impact of loss of jobs due to AI adoption by companies and their economic metrics? Yeah, such an interesting, swirling question right now.
Yeah, I think I think AI is a significant innovation wave that's coming. It could be as powerful as the PC. It could be as powerful as assembly lines and vehicles. Like I think we'll look back in 20 years and see this as a significant technological innovation. Okay. I think one of the first things that I see, and again, this is sort of taking off the investor hat and putting on the futurist hat a little bit. I think the barriers to entry for new companies is likely to be lower. So to the extent you're offering a software solution, it's going to be really fast to build a product. So I actually see more competition in the early stage companies because everyone will be using largely this tools with the same capabilities to solve the same problem. So I think you're similar to that like photo example I was giving. You're just going to see a lot of competition. And so I think it might actually make some growth industries more challenging at the beginning phases. And I think the positive implications could be around really enabling people to be more effective. So You can take law firms, which have a large army and a large pyramid of employees. Perhaps they may need fewer people at the lower end of the pyramid, and so you could see some, job restructuring. So we do tend to focus on where the jobs could be lost, and a little bit less time on where the jobs can be created. And I think more importantly, it's going to give people more of a superpower in terms of their ability to be productive, get to the right answer quickly. Like you can think about all the different applications in medicine. I don't think we'll necessarily need fewer doctors, but those doctors can be really productive. And so it's often in a period of innovation, and it's easier to see where the jobs will be lost and where the jobs will be created. I take comfort in humanity that through innovation cycles, it's actually been a source of growth in the labor pool. And the reality is we have a labor shortage across a wide range of industries. So perhaps this merely just fills that gap.
Fantastic. Okay, another question. There's one on market cycle, but I'll go to this one first. So on the long side, your style, is it value, growth, momentum, something else? How do you describe it? Do you want to put it in one of those?
I would say I'm style agnostic. So if you looked at like my top 10, you would see growth stocks, you'd see value stocks. You would see over time a bias towards more mid-sized companies than the very largest companies. I think the market cap of my average holding might be 50% of that of the index. And really that's just a product of our ability to do research deeply into companies and industries and find companies that can grow fast. They can grow fast because they're introducing new products. Perhaps they have a better way of doing business. And those companies are really what I'm hoping to be sort of the next big S&P 500 companies 10 years from now. Because there are challenges as you approach a large scale of outgrowing your industry when you have a high market share. But if your starting point is a moderate amount but growing market share, that those can be powerful stock drivers over time.
So interesting. I like your futurist cap in there on some of that. So just maybe a quick comment on the market cycle, and then I want to ask you about sort of what the next couple of years might look like, particularly for your fund. But where are we in the market cycle?
I think where we are is you just take sort of the conditions we have today. You have interest rates that are higher than they used to be, and maybe they'll come down, but they'll probably remain higher than they were. So I think regardless of what happens, all the things I said about companies who have the wrong balance sheet, I think that still holds true. I think we are at a phase where multiples have expanded for a lot of businesses. And typically in a soft landing, that's what happens. People get really excited about earnings growth, and then the earnings growth needs to materialize. And I think we're in a market where you're seeing that for some businesses, where earnings recovery has been strong. Like earnings estimates have largely held up, and growth is coming through at sort of an above trend rate. But there are companies that are not delivering, and those companies are being punished. So I think there is a bifurcated market of companies that are delivering earnings and companies that aren't. And if you notice, I always try to bring it back to what we really believe at Fidelity, which is that if you can find companies that are going to deliver better results than the market expects at a valuation you can get comfortable with, it doesn't necessarily mean a low valuation, doesn't necessarily mean a high valuation, but something that you can underwrite as an investor, there's always going to be opportunity. So I do think that the election is going to, US election is going to gather a lot more noise over the last 6 months. And, hopefully as an investor, the preparation I've done for that, over the last 6 months has given me a window into the portfolio that, both protects the fund from risks as well as exposes the fund to potential positive change that could come from the US election. Then I'm sort of ready for that environment, but I do think that's going to be a big deal.
Yeah, okay, really interesting. So just broadly on the concentration piece, this allows you to, you'll say it, does this allow you to kind of parse that? Your style will allow you to parse that out?
Yeah, I think so. I think so. And you always have to go to where the opportunities best lie. But I think it's, as you look at the progression of, stocks that are like the most exposed to the most obvious theme, really the highest prospective returns often come from thinking about what's next.
Right. Okay, we're going to leave it there. David Way does think about what's next all the time from every interview we've ever done. You can always hear that underlying. Thank you for joining us.
Yeah, thank you for having me.
Bye.